Hello, students, and welcome to this explainer on IND AS 27. Today, we are going to completely master the core principles of separate financial statements. This is an absolutely crucial standard for accounting professionals, but do not worry, we are going to break it down using very simple, clear, professional terminology. By the end of this, you will understand it perfectly. Let's get started.
Okay, let us take a quick look at our agenda for today. We will cover the objective and scope, the important definitions, preparation rules, group reorganizations, disclosure requirements, and finally, a comparison between IND AS 27 and IAS 27. Let's dive right into Section 1, Objective and Scope. So, what does this standard actually do? Well, it provides the specific rules for accounting for investments. This applies when an entity chooses or is required by law to present separate financial statements. Now, keep in mind, IND AS 27 does not actually force anyone to make these statements. It just says, if you do prepare them, you absolutely must follow these rules for your subsidiaries, joint ventures, and your associates.
Moving on to Section 2, the important definitions.
To get the accounting right, we must first understand the terms. There is a very important distinction between separate and consolidated financial statements. You see, consolidated statements treat the parent and all the subsidiaries as one single economic entity, like one big family. But separate financial statements, that is when a parent or investor presents their accounts where the investments are accounted for strictly at cost, or under IND AS 109. It is a simple but very critical difference. Take a close look at these 10 terms. IND AS 27 actually borrows these directly from other standards, specifically from IND AS 110, 111, and 28. Words like associate, control, subsidiary, and joint venture. They carry the exact same official definitions here as they do in their parent standards. So the good news is you do not have to relearn them.
Now, please pay attention to this rule from paragraph 7. Financial statements that use the equity method are never considered separate financial statements. Usually, separate statements are prepared alongside the consolidated ones, but there are a couple of exceptions. If an entity is exempt from consolidation, or if it is an investment entity using the consolidation exception, then these separate statements might be the only ones they present.
All right, let us move to Section 3, Preparation Rules. This is where we get into the actual accounting mechanics. When preparing these statements, you face a major choice. You must account for your investments using either the at-cost method or under IND AS 109. The golden rule you must remember here is consistency. You have to apply the exact same accounting method for an entire category of investments. You cannot just mix and match them. Let us look at 3 specific scenarios. First, if you measure investments at fair value in your main statements, you must do the exact same in your separate statements. Second, if an at-cost investment is suddenly held for sale, you have to switch to IND AS 105. But if it is under IND AS 109, the measurement stays exactly the same, even if it is held for sale. Finally, for dividends, you only recognize a dividend in profit or loss when your legal right to receive it is firmly established. But what if a company changes its status? If a parent stops being an investment entity, it must account for its subsidiary either at cost, using the fair value on the date of change as the new cost, or it continues using IND AS 109. Now, what if the reverse happens? If it becomes an investment entity, it must switch to fair value through profit or loss. Any difference goes directly into the profit and loss statement. Next up is Section 4, Group Reorganizations. Imagine the structure of the group changes. Paragraph 13 gives us 3 strict conditions for a new parent company. Condition 1, the new parent gets control by exchanging its equity for the original parent's equity. Condition 2, the actual assets and liabilities of the group do not change at all. Condition 3, the owner's interests stay exactly the same. If all 3 are true, and the new parent uses the cost method, they simply measure their cost at the carrying amount of the original parent's equity share. Simple and straightforward. Let us now look at Section 5, Disclosure Requirements. Good accounting is all about complete transparency. So if a parent is exempt from preparing consolidated statements, their separate statements must clearly state that they are using that exemption. They also need to tell the reader exactly who is producing the consolidated statements. That means providing their name and address. Finally, they must list out all of their significant investments and the exact accounting methods used for them. What about an investment entity parent? If separate statements are the only statements they make, they must disclose that fact very clearly. Plus, they have to provide all the specific investment entity disclosures that are mandated by IND AS 112. And for all other parents who do not qualify for those exemptions, you still have rules to follow. You must clearly identify your related consolidated statements. You must explicitly state that what you are presenting are separate statements. And again, you must provide that detailed list of your significant investments, ownership percentages, and your chosen accounting methods.
Finally, we reach Section 6, a very important comparison: IND AS 27 versus IAS 27.
As accounting students, you most know how Indian rules differ from the global ones. Here is the massive difference. IAS 27 actually allows entities to use the equity method, but IND AS 27 completely removes this option. Why? Because the equity method is basically a consolidation technique. It is not a pure measurement of cost or fair value. Using it in separate statements creates inconsistencies. Also, IAS 27 makes you explain why you are preparing separate statements if they are voluntary. But in India, the Companies Act makes them mandatory, so IND AS 27 simply drops that disclosure requirement.
So as we wrap up today, I want you to think about this question. How will choosing the at-cost method versus the IND AS 109 method impact your future company's bottom line? The accounting method you choose directly impacts how investments reflect on the company's financial health. Mastering these principles ensures you will make the right professional calls in your career. I hope this explainer made the standard very clear and easy to understand for you. Please like, share, and subscribe for content like this. Thank you for learning with me today.